Can't blame the stock market for being skeptical. In late February of 2021, Jerome Powell testified before Congress, and all of a sudden, sounded a bit more mean, like he wanted to spank us around a little bit. He didn't come to tell us that everything was okay. This was even after my Bloomberg terminal code said pray, and the stock market started falling after February 19th, 2021. In November 2021, the Fed dropped the phrase transitory to describe inflation that wasn't, and in December, they went full-on meanie mode to work towards reining in inflation by talking tough to us about how inflation was the #1 priority. This talk turned into markets realizing the Fed was willing to risk high unemployment and a recession to eliminate inflation for fear of returning to the 1970s style of uncontrolled inflation and unanchored inflation expectations. Well, this week, the NASDAQ, via the QQQ, the tracking ETF, returns to its famous 318 retracement level. Now, that sounded really complicated, so simply put, we's back down 4.5% from highs that we hit just a week ago. And if you're wondering why, the likely answer is the Fed. But there is more, which we'll talk about that more as well. Hey everyone, me Kevin here. In this video, we're gonna break down some need-to-know catalysts for this week for August 22nd. And speaking of dates, since I want to simplify things and keep things a little bit more streamlined now on this channel, I'm just going to put up on screen all of the beautiful reasons why you should be part of the programs on building your wealth and using that coupon code that expires on August 26th, which is just in 4 days for all of the programs, whether it's stocks, real estate sales, YouTube, making YouTube videos, property management, or rental properties. All right, folks, let's get into those catalysts we gotta talk about. So first, Jackson Hole Friday. Jackson Hole Friday is a big deal because Jerome Powell is probably gonna talk mean to us again. He's going to continue to talk about, hey, look, we may have had good inflationary numbers that came out here in the last CPI report, but we've played this song before. When we saw what we thought was peak inflation in March, what ended up happening was we got a little bit of a decline in April, and then we went to a new high right after that in June. And now this is really important because the same thing could happen this time. We just came off a new high of inflation, we've inflected down, and we could be going right back up. Now, it's unlikely because commodity prices are still trending in the down direction, and while there are a lot of fears that commodity prices could skyrocket again, it's unlikely that we're going to see oil go to the moon anytime soon with the disasters going on over in China. So it's hopeful that inflation has peaked and will continue to trend down for the rest of the second half of the year, leading JP Morgan to call for a very bullish second half of the year after the September Federal Reserve meeting. Note, that's because the Federal Reserve meeting in September happens on September 21st. CPI data comes out about 10 days before that. And that's really important because we don't have that data yet. So what we're going to get this Friday is Jerome Powell, who talks about how they will be succeeding in their inflation goal, but they won't stop until inflation gets back down to 2%, even if that means we end up facing a mild recession. I would expect that Jerome Powell will drop all mentions to a soft landing since we're technically in a recession, and he doesn't want to seem like somebody who doesn't know what he's talking about because, let's be real, he knows that we're in a recession. And it's this fight against inflation that's helping push the 10-year treasury yield back to 3%. That's actually a pretty big deal since just about a month ago it had fallen as low as 2.5%. Now, usually a higher treasury yield can lead to more people going to buy bonds rather than investing in stocks, and so you could see some weakness in the stock market compared to your opportunity to get a risk-free 3% on 10-year treasury bills right now. Unless you think America is going to go bankrupt, you could get a risk-free 3% yield every single year for the next 10 years buying U.S. Treasury bonds. Now, when we say risk-free, that's because U.S. Treasury bonds are deemed to be risk-free by markets. But anyway, that yield will probably lead to more real estate pain. Now, the higher and longer real estate or 10-year treasury yields stay high, the longer we expect mortgage rates to stay high, and the more we expect the fear of real estate potentially peaking and coming down to take hold and finally lead to supply exceeding demand, which will then likely lead to price reductions. So far, though, we still have a supply-demand imbalance in favor of a lack of supply, so we'll see that transition continue to happen this year. Either way, Friday's Jackson Hole Summit, where Jerome Powell talks dirty to us, is probably going to do not much for that 10-year treasury yield, and we probably won't see any certain optimism for markets until we get that September CPI reading, because markets think we might just be getting clickbaited like we did in March and April. Tomorrow, we'll get some manufacturing and service PMIs, which are great for some leading indicators on pricing action. But then again, you have people like Elon Musk raising the price of full self-driving again, even though I still don't have full self-driving, even though I paid for it twice in 2 different cars. Anyway, on Thursday, we get quarter-over-quarter GDP reads along with personal consumption data. This will be really interesting because we'll see, hey, is the third quarter so far potentially looking like it's continuing in its track of being in a recession, or have we recovered out of a recession? And how is that spending holding up? So far, every quintile of personal incomes have more income and more savings than they did at any part earlier in the second quarter. And they're spending more money than they were in the second quarter. So hopefully that means we're spending our way out of a recession, especially since the consumer makes up 70% of the economy. We do have earnings coming up, which might give us some hints into how things are changing and maybe indicators that the second quarter was a bottom. Hopefully, we'll get some dirty earnings from NVIDIA, which have already been pre-released. We'll get Macy's, Nordstrom, Dell, Salesforce, and Peloton. And in my opinion, the longer we spend under 318 for the QQQ is a perfect buying opportunity, not only for the programs of building your wealth, no, but for actually, in my opinion, getting great deals on stocks. I think 318 is the perfect level to look and say, okay, the more we are below this, the better deal I'm getting, but even at 318, this is a good opportunity to be looking at the fact that we're in a recession, at least a technical recession, and going, best time to buy is in a recession, so let's go. Thanks so much for watching, and I'll keep you updated with more news as it comes in. Thanks, folks. Bye.